Good afternoon, everybody. I do hope that we're still enjoying being locked away in our homes, but these are the price we have to pay, I presume, in order to get the health equation right. Obviously, I'm as focused on the health equation as I am on the economic equation. But today I just wanted to take a little bit of time to quickly run through the economic equation with you and just give us a bit of an idea about what we can sort of see starting to emerge. It can be really difficult when you're in the midst of a significant kind of crisis like occurred here in Australia, latter half of February running into March. It all gets fairly jumbled and it can be difficult to get your head out of it to sort of see where we're at. And particularly when you're dealing with something like a virus, when you don't really know, or we didn't really know in February and early March, just what was going to happen, whether we were going to have, the projected hundreds of thousands of people being infected and dying. So now that sort of has eased, and we've come to a point where we can sort of start to coldly analyse things as opposed to trying to just work out day to day what's going on. It gives me an opportunity to at least run through some thoughts with you, which I'll do just now. What's interesting, this is what we call our investor cycle, and it works particularly in share markets and property markets. But what's interesting is how time compressed this particular chart has become. If you look here, and this assumes that we were running through this period here, which is essentially worked out being the period from about 2009 all the way through to about 2020, where optimism in the market built, the share market went into a bull run, everything was really ticking along extremely well. You've only got to think back to economic forecasts like 2019 suggesting global growth at sort of over 4%. And now we're just 3 or 4 months later into the year and we're forecasting global growth to be minus 6%. So a 10% turnaround in global growth is something we've never seen before. But if we look at this chart and try and work out that compression, it's rather interesting. This period of time took the best part of 8 years to build. And then from this peak, which actually hit us kind of around about the 24th, 25th of February, we went through all of these emotions: anxiety, denial, fear, desperation, panic, regret, and despondency, all of those in a matter of weeks. So all of this period took a number of years, and this period here, all the way back down to here, has taken the best part of about 5 weeks, which is staggering, but we've never really seen the impact of a global pandemic on world markets before. So the question is, where are we in this space? And I think that, as most of our clients would know, and most of the people just generally speaking would say, we've gone through panic. People have gone past the panic stage, which means they're into this kind of lull of somewhere between regret and hope, effectively, because what we have seen has been a turn in world markets. So if we look at back to our chart again for the Australian share market over the past 3 months, what we can see is that, I've been through this with you before, but what we can see is we've had this really sharp fall off the cliff. We hit the bottom, which actually occurred on the 23rd of March, which is exactly from today, 1 month ago. And since then, we've kind of got this mixture of fear and hope, which goes back to this chart, somewhere in this hope, panic, fear area in the bottom of this cycle. Now, I expect there's going to be significantly more volatility in the market because there are still so many unknowns in the market. But what's interesting is the fact that it has tended to flatten out. And if you wanted to have a really good picture of things, and this is maybe a little bit cheeky, but all you have to do is look at the performance of the share market in the past month. If you looked at this particular chart, you'd be saying to yourself, I'd be crazy not to be investing in this market. But of course, it is literally from the 24th of March until the 20th of April. So it's a very short scale. But it's just interesting to note that even still in this month of recovery that we've seen, we've still got volatility, and that volatility is going to continue. And I'm not for 1 minute suggesting that we're anyway near out of the woods, but I think that the market is starting to factor in the possibility of the restrictions being lifted and the possibility of companies going back to earning money again, meaning that the forecast for even something as short term as the September quarter might not look so bad. What I also wanted to quickly highlight to you, because I've done this before, was the dislocation that's starting to occur between the share market and the Australian dollar. This is the Australian dollar versus the US dollar, obviously. And what we're seeing is the white line being the Australian dollar and the red line being the Australian All Ordinaries 200 index, or effectively the Australian share market. And what you can see is they moved quite strongly in unison all the way through January, February and March. And down, and just lately, as we expected and as we've protected in some of our managed portfolios, the Australian dollar has started to separate from the Australian share market. This will happen because the commodity prices and the fact that China has got back on its feet faster than some had expected earlier means that our commodities are going to be a little bit more in demand. So consequently, companies like BHP, Rio Tinto are starting to feel the effects of this, whilst the Australian share market curve is probably still lagging back a little bit as far as things like the performance of companies like airlines, retailers, and leisure companies. But interesting, we'll keep an eye on this and see if the Australian dollar continues to diverge away from the Australian share market. I think the other point that's been of dramatic interest over particularly the last 48 hours has been the collapse in the global oil price. Now, oil prices fluctuate quite significantly under normal circumstances, but the oil price went negative the night before last. Now, that doesn't mean that you're going to be buying petrol at minus 40 cents a litre. What it means is that the futures trading on oil is saying that there is now so much supply of oil in the world that we simply have nowhere to store it. Now, that the countries that produce oil, countries like the Arabian Peninsula, that includes United Arab Emirates, Kuwait, and then Iran and Iraq, and then countries like Russia and some South American countries, their economies are totally dependent on selling oil. So essentially, they won't leave it in the ground. They're going to pump it out of the ground because that's going to keep their economy alive. But because of the global slowdown, we're not using nearly as much oil as we used to, and consequently, we're getting this sharp fall in price, largely or almost exclusively due to a massive oversupply in oil. Now, this actual minus 40 that we're seeing on the screen here, it actually completely corrected itself in the last 24 hours, and we've seen spot oil prices move back up to that kind of $15, $18 a barrel mark. And I would expect to see the oil price reasonably low for another, 4 to 6 to maybe even towards the end of the year, 4 to 6 months towards the end of the year. And this will help global recovery because obviously lower oil prices means lower transport costs, which means to lower prices, which is good when people don't have a job. Also wanted to quickly touch on one of the knock-on effects that we can quickly identify, and that's going to be construction. And the Australian economy is very dependent on construction. What I can just go through here with you is that freestanding home construction in Australia is already at a 6-month low. And certainly we've never seen it that low for quite a long time. New home sales fell by over 20% in March, and we're expecting the same kind of fall in April. And you're looking at, the only stat that we've got through in relation to the building industry and building products is timber, which the forwards markets in timber are showing a 50% decline in the sale of timber. So what that essentially means is that we're going to see a really sharp correction in the housing market. So if you're thinking about buying property, maybe early 2021 would be a very good time to do it. If you're thinking of selling property, it might be a good time to not do it. So I just wanted to finish also on a question. This is actually a question that came from one of my clients this week. And this is showing a breakdown of Australian superannuation, where there are more than $3 trillion worth of assets invested. Here we can see 33% of that money is invested in retail funds, AMP, ANZ, MLC, those sorts of companies. 27% is in self-managed superannuation funds, which a number of our clients have. 17% is in public sector funds, so the super funds run for the public servants. And 15.5% is in industry funds, and 8.7% is in corporate super funds like the IBM fund or the or a large corporation that runs its own super account for them, for their employees. And this small amount is in 2.6% in other. What the question was my super fund's been badly damaged. Can the value of my fund fall to zero? And the answer to that is no. Superannuation funds invest across a broad cross section of assets. And you'd have to assume that every single asset in the country went to a value of naught. And that's simply not going to happen. Yes, superannuation funds have been affected, but the recovery that we've started to see has taken hold. And I don't think that the share market or our super fund balances are going to rebound directly back to where they were in January and February of this year. But we will see a slow and concerted recovery as the virus runs its course and as the economy starts to click back into action again. And that was basically the advice that I provided right from the very beginning, which was selling and getting out of this industry now or then just wouldn't work. We would be in a position where we would be having our money in cash, which is theoretically safe, but we would not be involving ourselves in any way, shape or form in the recovery. So look, they're just some of the thoughts that I've got at the moment, some of the things that we're thinking about. Anything that you'd like to talk to me about, we're always available. I'll keep pushing out video content for you so that you can keep abreast of what's going on. And hopefully my plain English examples and plain English sort of discussion allows you to navigate through what are often complex issues and issues that we don't deal with regularly. You know, we don't regularly deal with pandemics. It's a fairly unusual set of circumstances. And it does get us to focus on things that we probably previously didn't pay much attention to. So stay safe, look after everybody, and I will talk to you very soon. Bye-bye.